Well, quarter one of 2026 in the Canadian mortgage market can really be summed up with one word: uncertainty. The Bank of Canada started the year by holding its policy at 2.25%, and most economists expect the central bank to remain cautious for much of the year. That decision has provided some predictability for homeowners approaching renewals and buyers trying to plan ahead. But even though the Bank of Canada has paused, mortgage rates themselves have not been perfectly stable. Over the past few weeks, the 5-year Government of Canada bond yield, which drives fixed rate pricing, has jumped from roughly 2.6 to around 3%. When bond yields move like that, lenders' funding costs increase and fixed rate mortgages tend to move higher as well. The reason for that shift is largely global uncertainty rather than domestic data. One factor is the continued volatility in U.S. economic policy, including tariffs and upcoming review of the Canada-US-Mexico trade agreement. Policy decisions south of the border can ripple through global markets and affect inflation, expectations, and bond yields. Another factor in geopolitical conflict, particularly tensions in the Middle East involving Iran. Rising oil prices and concerns about global instability tend to push inflation expectations higher. When markets worry about inflation, bond yields often rise, which can push fixed rates even higher if the Bank of Canada isn't even doing anything. Meanwhile, Canada's housing market has remained cautious. Sales activity has been relatively soft in many regions, listings have increased, and many buyers are still waiting for clear affordability or economic signals before jumping back into the market. Most forecasts still expect modest improvement throughout 2026, with slightly higher sales data and home prices growing roughly in line with inflation rather than surging higher. One interesting implication of this environment is the difference between fixed and variable rate mortgages. Variable rates are tied directly to the Bank of Canada policy rate, so they remain somewhat less volatile in the short term if the bank continues to hold its current position. However, if inflation pressures persist, whether from extended geopolitical conflict, rising oil prices, or escalating tariffs, the Bank of Canada may eventually have no choice but to respond with increases. And as we saw in 2022, when inflation accelerates quickly, central banks can move rates higher very aggressively. So the takeaway from the first quarter is this: the Bank of Canada may be paused, but mortgage markets are still moving. Quarter one reminded us that Canadian mortgage pricing is never just about the Bank of Canada itself, and it's never just about Canada. It's also about bond markets, inflation, volatility within U.S. policies, and global conflict. And that's exactly why fixed rates have been moving even when the bank has stayed on pause.